Hi, I'm Tony Filippone. I'm the Amazon best-selling author of Financial Planning for the Not Yet Wealthy, and I've also written this book, How to Have a Happy and Stress-Free Retirement. Both these books are available on Amazon.com. So I wanted to record this short video about investing in general because it's just this confusing topic to so many people. So I wanted to make it simple. I'm going to give you all of the different investments, so to speak, under the sun in 7 minutes or less so that you can easily go out and explain this to your neighbor and sound like a genius. Does that sound good? Great, let's get started. And that's what we're going to attempt in this short video here. So what everybody ought to know about investing. And before I get started, I just want to say this video is not meant to give you specific investment advice. You should always speak to your investment advisor. And of course, if you want to speak to us, we'll show you how to do that too. So let's check this out. So here's the deal. There's really always been these two worlds of investing, right? The world of safety, and then over on the other side is this world of growth. And in both worlds, there are just three entities in each world that you need to know. So let's start with safety. In the world of safety, there are banks, there's the government, and there are insurance companies. And those are the three. Those are the three main places you can go if you want to invest for safety. So if you went to a bank, what would they put you in if you want to keep your money safe? Well, you know the answer to that, right? It would be like a CD or a savings account. If you went to the government, I bet you could guess what safe investment vehicle you would purchase through the government, and that would be a government bond of some sort. And if you went to an insurance company, they also have a safe tool for investing called a fixed annuity. Now, if you're not familiar with annuities at all, because they can be confusing, just think of that as like a CD, because it's very much like a CD. Basically, you're getting a period of time with a fixed interest rate, and that's it. Except with a insurance company, usually the period of time is a little longer, and the growth rate is usually a little higher. So all three entities, though, have the same things, three of the same things in common. They all share these same basic underlying principles, which are, if you go to the world of safety, you are going to get a guarantee of your principal, right? Because that's what you're looking for. You want your money to stay safe. You want it guaranteed. You're also going to get a guarantee of interest. You're going to know how much interest you're going to get before you get it, and it's locked in and fixed. It doesn't change. So those are two neat things. Those are things we like, right? So what's the trade-off? What does the world of safety get from us? How do we pay them? Well, we don't pay them with money. We pay them with time. And I know that might sound weird at first, but really think about each one of those safety items. We're trading time for money, right? When you put money in a CD or savings account, you're agreeing to leave it there, usually for a period of time. And I mean, if it's just a savings account, you're not really, it's pretty liquid. You can take it out tomorrow. But then the growth rate is very, very, very minimal, right? CD, you're leaving it there for a little longer, so you get a little bit better interest rate. The same thing with a bond. The longer the bond, typically, the bigger the interest rate, and the same thing with an annuity, right? You're trading in order to get that interest rate. What you're saying is, hey, you can use my money for a little bit. You can go out and make a little bit more than you're going to pay me, and all the risk is on you because at the end of the day, you're going to pay me my money and you're going to pay me my interest. So what you're agreeing to is to leave it there for the period of time so that they can hopefully make a little bit more than they have to pay you. That's how they stay in business. So that's how they get paid. So that's the world of safety. Then there's the world of growth. The world of growth, you can go to a brokerage account. You can use, there's three entities again, a brokerage account, an RIA firm, which stands for Registered Investment Advisory Firm, or an insurance company. Those are the three main entities you can buy growth. And if you go to a brokerage firm, they're going to sell you some kind of mutual fund, stock, or exchange traded fund, which is just mutual funds and ETFs are just groupings of stocks. And then you could go to a registered investment advisory firm, and there you're going to get something a little different. You're going to get managed money. You're basically going to hire a money manager to figure out what investments to put you in. And if you go to an insurance company, a lot of times you're going to get those same mutual funds, but you're just going to buy them inside of an insurance company wrapper or package. And that's usually called a variable annuity. Now, no matter which way you buy growth, three things are going to be the same. One is you get an unlimited upside. If the market's up 40%, you're going to make 40%. There's no limit to the gain. What does that come with? You guessed it. It comes with an unlimited risk or an unlimited downside, right? If the market drops, the bottom drops out of the markets, the bottom drops out of your account. That comes with the territory of growth, right? And how does the growth side of the world get paid? They usually get paid with fees, commissions, and charges. That's how the growth side gets paid. Now, until very recently, about 15 to 20 years ago, I guess now, there was only these two worlds, the world of safety and the world of growth. But then this world kind of cropped up in the middle called the world of indexing, it's called. So it's just kind of this world that kind of fits in between the two worlds. And you can almost guess who came out with this world, who was the one to really come up with this hybrid type of an investment that was a little of both, a little of safety, a little of growth. Well, which entity existed in both worlds? If you're thinking insurance company, you're right, because the insurance company exists in the world of safety and they exist in the world of growth. So they came up with this world in the middle that I like to call the world of indexing. And it could be an indexed annuity or it could be an indexed life plan. There's different ways to create indexing. But what is indexing? Because it's a new phenomenon, really hasn't been around more than 15, 20 years. So what is it? How does it work? Well, I'm going to explain that to you here briefly. We're going to explain it by comparing it to the stock market. So let's say you had $100,000 to invest and you went out and put it into some mutual fund, let's say an S&P 500 fund, and the S&P went down 10%. How much money would you have at the end of the year, at the end of year one? You put 100,000 in, it's in the market lost 10%. What do you got in that account at the end of the year? If you said 90,000, you're correct. You'd have $90,000 in that account. Now, at the end of year two, what happens at the end of year two? Well, oh, wait a minute. Year two, it bounces right back. It made a 10% gain. So how much would you have in your account at the end of year two? You lost 10%, you made 10%. You should be even, right? Not so fast. That's a trick question. You'd actually have only 99,000. Why? Well, because when you were down there at the bottom, you needed more than 10% growth just to get back to even. It's kind of weird how math works that way. So year three comes along and we lose another 10% in this S&P fund. What do we have then? Well, we've got $89,100 at the end of year three. Not doing so great so far. The end of year four, the market's back up 10%. Oh, hey, that's good for us. We should be back to even. No, we're up to 98,000. So just stop right there and look at that for a second. Kind of weird, right? Down 10, up 10, down 10, up 10. We should be at averaging 0% rate of return, but we didn't. We lost almost $2,000. And that's the problem with one of the problems with having money that fluctuates. Averages lie. We have an average rate of return of 0, but we have less than 0 growth in our account. We have a negative in our account. Now, what happens after year 5? The market's up 10%. Hey, finally, after 5 years, we've made a profit in the S&P 500 mutual fund that we bought. Now, let's look at how this would have worked in an equity indexed annuity as an example, or using this index strategy. So I just kind of gave away my answer there. But if the market drops 10%, remember in an indexing plan, it's part of that world of safety. So if the market is down, you're protected. But if the market's up, you also have a limit on your gain. So let's take the first scenario. The market drops 10%, but you're in an indexing strategy that protects your principal. Well, if your principal is guaranteed and protected, like in the world of safety, what are you going to have in that account? Well, you're going to have the full 100,000 because your principal was protected. Well, then next year when the market's up 10, how much are you going to earn? You're going to earn the whole 10%? Well, no, that would be too good to be true. Right now, if we're giving you no downside protection, there has to be a limit on the upside protection. You can see it there. In this case, we're showing a 7% cap or limit on the upside gain. So, and again, this is a hypothetical example. So the market's up 10, you made 7, you're at 107,000 because you never lost any money in the first year. How about the next year when the market's down 10%? Well, not only is your principal protected, but so is the growth that you just locked in from last year. So you don't only get to keep the 100, you get to keep the 107. Well, now year 4 comes and the market's up 10 and you only get 7, so you're at 114. Year 5, the market's up 10 and you get 7, you're at 122. So, I mean, you don't have to be a rocket scientist to say which one would you rather be. In this scenario, we'd probably rather be the guy who put the money in the indexing, right? Now, would you like to see how this would have worked out in real life? I'm going to give you a real life scenario, and it's from a couple of years back. One, because I've been teaching this strategy to people for decades now. Two, because I just haven't updated my slides. So we're going to look back from 2003, but I think this is a really good example. We're going to go back to 2003, and we're going to go from 2003 all the way to 2015. So it's about a 12-year spread, and let's take a look at what that looks like. So if we look at this, we can see here at the beginning, this is where we both start at the same point, and the green is the S&P, and the pink here is the indexing account. So the first year we're kind of neck and neck, right? We both made about the same. Wouldn't have mattered which one we invested in. Year 2 comes, and yeah, we're still kind of neck and neck. Year 3, the market does much better. Look, I mean, we're way ahead. And by year 4, wow, the market's really up and it's doing better. Why? Because there's no limit to the gain. So at this point, you know, your friends are telling you, hey, why did you buy that indexing thing? That's crazy. You know, you could have been up here with me. But then, you know, the housing market crisis happens and wham, we had this big drop off in the market. But notice your account didn't drop off at all. It went sideways. It just kind of didn't lose any value. So then your friends now are down here in the hole trying to dig themselves out of this hole, and you didn't lose at all. In fact, when the market starts coming back, you're coming back from this high because you locked in your gains, right? So you're way up here. So now you're this much ahead of where they are. Now, if you look over time, you know, the market starts creeping up, and eventually the market passes you up, which is fine because you know what? We didn't put our money into this indexing strategy really to try to beat the market. That's really not the idea. The idea is to try to avoid this, right? We don't want this mess right here. We just want to skip over that and go right to the gains. So in the end, the market did better. That's what it was supposed to do. But we had a lot less headaches and a lot less volatility, which made it easier to stick with the program and continue to lock in those gains year after year. So that is the idea. Sorry, let's get to my next page of the indexing. Now, is indexing or index annuity some kind of perfect investment? Is this like the best investment in the world, the only thing you should ever do, and you shouldn't invest in the stock market? And is that what I'm saying? No, there is no perfect investment, right? There's pros and cons. So what are the cons? Why wouldn't people want to invest in this indexing? Well, when the market is up, you don't get all the gains, right? There's a limit to how much money you can make. Your friends could be making 20% gains, and you're only going to see a limit up to a cap, some kind of limited gain. So that's the trade-off, right? There's limited gains. So if that's the case, if we're going to limit our gains, why would anybody even buy an indexing account? Well, why invest in something like this? Well, if you're thinking, well, yeah, but I didn't ever lose any of my principal, and I really feel good about that. I kind of like that idea. Well, then you've got the idea. That's exactly how this whole indexing thing works. So if indexing is new to you, you know, investigate it. Call us if you need help with it. We've been helping people with this for years, and it's a strategy that absolutely works. It's not the only thing we do, but it certainly makes up a nice piece of a good financial plan for a portion of your money, particularly the portion that you don't want to put at risk. And the portion that you might want to draw income off of works very nicely in this type of a product. And it also frees up the rest of your money to be more aggressive in a growth portfolio. So we think both are important. Both ideas are good concepts. But if you're interested in learning more about this, please let us know. And your next step on this page is a video that you can go to, It's about 10 to 12 minutes long, and it talks all about how you can avoid going broke in retirement while securing your nest egg. So check that out. I think you're really going to like that. And at the end of that, there's an opportunity to schedule a time to chat with me if you're open to that. So please watch that video now. And thanks so much for tuning in. Have a great night.